Hello everyone, today we'll analyze Infosys Limited, which is an Indian company providing consulting, technology, and digital services for clients in 56 countries around the world. Infosys has the potential to last for a very long time and overcome many economic downturns because it has zero debt. If you're shocked by that, then that is the both of us, because that is the first time I have seen a publicly traded company with no debt at all. In addition to that great thing about Infosys, the revenue sources are well diversified. There is one thing that is not going in the company's favor, which is their ability to generate value for the shareholders, as we will see in a minute. Before we dive into the analysis, I want to remind you that this video is not financial advice and for entertainment purposes only. Infosys is listed in the New York Stock Exchange market under the ticker symbol INFY, which is their only class of equity security. The company reports its operations in a fiscal year that ends on March 31st of every year, and the 2022 audit report is a clean report, so we can trust the financial statements and use them in our analysis. A nice thing about this company's annual reports is that the financial statements are prepared in US dollar, as you can see here, which makes my life much easier because to build the analysis report, I collect the data that I need from the financial statements, not just from 1 or 2 years, but for the past 6 years, and I don't have to worry about currency exchanges in this case. Now let's look at the business segments. Infosys has 8 business segments, and in 2022, the financial services segment made about 30% of the revenue, 14% retail, 12% communication, 13% energy and utilities, 13% manufacturing, 8% high-tech, 7% life sciences, and all other segments made about 3% of 2022 revenue. This is a very well-diversified business segment, which helps Infosys overcome any economic slowdown in any one of these industries. When we look at the 2022 geographical revenue sources, we find that 62% of the revenue was made in the North America region, 25% Europe, 10% the rest of the world, and only 3% was generated in India. Which tells me that Infosys has more international clients than domestic clients, and this fact that the company is servicing many clients in different countries is also a thing that improves the company's ability to overcome economic downturns in one or even a few of the countries that they service. Now let's compare the revenue, cost of sales, and operating expenses year over year. The revenue in the blue line is increasing every year since 2017. The cost of sale and the operating expenses are growing, but following the revenue growth, which is the thing that we want to see. The gross margins are unfortunately slowly decreasing from 36% in 2017 to 30% in 2022. But this is normal when companies get bigger and move towards maturity, so I'm not concerned about the gross margins, but what really concerns me is the free cash flow. In 2022, it went down by 17% compared to 2021, and as the graph suggests, 2022 is the lowest free cash flow since 2017. So if this situation continues to 2023, in my opinion, it will negatively impact the stock price. We don't have quarterly reports for this company to check their free cash flow in the first quarter, for example, because Infosys prepares the reports on the international standards, while American companies issue a report every 3 months. Scrolling down to the debt to asset graph, the company doesn't have any debt, which is something I have never seen before, and I think this will help the company to survive many economic downturns. The company knows that this fact is an attractive point on their side, so they put this fact on their website, and the investor frequently asks questions, as you can see here in number 6, that the company is free from debt and sufficiently generate cash from their operations to run the company. If you know any other company that generates $18 billion in revenue and has $0 in debt, please put in the comment section below, because I doubt that there is another one. Now let's check the outstanding shares. In 2018, there was a stock split, which explains the spike in the graph. And from that time to 2022, the company bought back about 4.8% of the outstanding shares, which means about 1% a year. When it comes to dividend, Infosys is a dividend company. In 2022, the dividend per share was 41 cents, which makes the dividend yield 2.4%. Now let's go over the forecast. I'm using the revenue to research and development expense ratio to forecast 2023 revenue. In my opinion, the 2023 revenue will be around 19.9 billion. The total free cash flow is around 2.4 billion, so I'm assuming that the 2023 free cash flow is going to be less than 2022. Using 99% of the outstanding shares, assuming that the company will buy back about 1% of the outstanding shares, and 5% return investment ratio, the intrinsic value is $11.10. This means that the share price is 54% overvalued. If we change the return investment ratio to 3.25%, then the intrinsic value is very close to the market price. But 3.25% return investment is too low. So the question is why it is overvalued. I think because of the fact of this company. It doesn't have any debt, issue dividend, buy back its shares, and grow every single year. This combination reduces the risk and create high possibility of massive future growth in the stock price. Let me know what you think in the comment section below. Finally, if you want to support this channel, you know what to do. Please subscribe and give this video a thumbs up. See you in another analysis video.